Hello everyone, welcome to the second video for chapter 8. And in this chapter we're going in this video clip we're going to talk about notes receivables and accounts receivable ratios. Okay, so first we're going to talk about notes receivables, but before that I remember a lot of my students ask me questions about what is the difference between accounts receivable and notes receivable when it comes to homework questions and when it comes to in-class practice problems, right? And why when should we use notes receivable and when should we use accounts receivable? And similar is true for accounts payable and notes payable. Okay, so accounts receivable is you make a sale to a customer for maybe $1,000 and they are going to pay you later, and you know that this is usually a customer that you know you have had for a while. All right, and it's kind of like put it on my tap sort of thing. All right, so it's not a real a formal deal, and there's no interest involved, and it's just gonna they're gonna pay you at a later date. All right, but a notes receivable is really like similar to a car loan payment, or you make a loan, you apply for a loan with a bank. All right, so it's real. It's more formal. You're gonna sign a bunch of documents, and to document your responsibilities and how much you need to pay by the end of which period of time, and then you're gonna not only paying the principals but also you're gonna pay some interest. That makes sense. So now let's look at this slides. All right. All right. Notes receivable is an interest revenue. Okay. So a company reports notes receivables if it uses a promissory note to document its right to collect the money from another party. Okay. So keep in mind that the difference between accounts receivable and notes receivable mainly is it's based on two things. Okay. First one is notes receivable is more formal, and the second thing is only in terms of receivables, only notes receivables that will give you interest revenue. Or another way of saying this, only notes receivable that bears interest. Okay, that bears interest or carries interest. Okay, and similar is true for notes payable. Okay, and it just depends on the size in that deal or transaction. You could either have accounts receivable or accounts payable. All right, or notes receivable or notes payable. All right. So now, unlike accounts receivable, which are generally interest-free, notes receivable charge interest from the day they are created to the day they are due. So that the day they are due is called maturity date. Okay, the maturity date. All right. So now let's look at this promissory note. Okay, this is an example. Okay, and on this note, it indicates the principal amount, that $1,000. If you are issuing this promissory notes receivables, that means you lend $1,000 to your customers or to some third parties. Okay, and the date of note, which is issue date, okay, it's July 1st, 2018. Okay, so this is the date when this $1,000 note is issued to your clients, your customers, or some third parties. Okay, and for how long? For 12 months. Okay, for 12 months, and it's indicated here also on the note. All right, and after date, I promise to pay to the order of, this is the payee. Okay, this is the payee, and $1,000 for value received with interest at an annual rate of 12%. That is the interest rate, and payable at the financial institute. Okay, who make this? Julia. Okay, Julia, and don't be confused by this. Really, a payee is who is receiving at the end of the day, at the maturity date, the payment by the payor, which in this case is Julia. Okay, it's Julia. Okay, so that means another way of saying this is, for this note, is Julia borrowed this $1,000 from TechComp company. All right, from TechComp company. And on the other hand, we can say this TechComp company, they issues this $1,000 promissory note to Julia, and with 12% annual interest rate for 12 months use. Okay, for 12 months use. Okay, so his promissory note means that Julia promised to pay back the principal of $1,000 plus 12% annual interest rate to the payee or the issuer, who is TechComp company. All right. Okay, so this is the abstract information from this note. The maturity date of a note is the date that note must be repaid. The payor has to pay both principals and interests when it's come to mature. Okay, so on July 1st, 2018, TechComp issued $1,000, 12 months, 12% this is interest rate, annual interest rate, promissory note to Julia. And remember here, keep that in mind. Every time you see the interest rate, it is always indicated as annual interest rate. It is not monthly interest rate. It is not quarter interest rate. It is not semi-annually interest rate. Okay, it is only annual interest rate. Okay, whenever you see this, if there's no additional specification, that will be only annual interest rate. That means for using that amount of money for 12 months, for 1 year, how much interest, the amount of interest you need to pay for borrowing the money. All right. So in this case, the annual interest rate is 12%. And when is this note issued? On July 1st, 2018, and maturity date is June 30th, 2019, and that'll be a year. Okay, a whole year, 12 months. So the note is due and payable, or has to be paid, on June 30th, 2019. Okay, so now we know that the principal is $1,000. That is the amount that we borrow from, or Julia borrowed from the company, and for use. Okay, when it comes to mature on that date, not only Julia has to pay back this $1,000 principals, but also she has to repay the interest for using that $1,000. Okay, so interest here for using that $1,000 for a year is 12% times $1,000. It's going to be $120 interest. Okay, so Julia has to pay $1,000 principals plus $120 of interest to TechComp company. All right. So now, how do we calculate interest? Right. This is our interest formula. Okay. Interest equals principal times interest rate times time, and interest rate here, even for maturity is less than 1 year, the rate is annualized, which means no matter what, you are going to have a annual interest rate stated on your note. Okay, that's only going to be a annual interest rate, not monthly interest rates and things like that, so to speak. All right, and the time here, if the note is expressed in months, based a year on 12 months. Okay, so it's a little bit complicated or hard to understand. Now let me show you. All right, so for example, I'll say interest equals principals times the rate and times time. And that is our equation, right? So what it means is that principal, let's say $1,000, okay? And this is a different example than the one we on the slide. All right, so let's say interest rate is annual interest rate 12%. Okay, and now we are borrowing this money for 6 months. Okay, 6 months. Then how do we calculate this interest? Right? So that still will be $1,000. And interest rate, remember, it's always gonna be annual interest rate. Okay, if the notes is expressed in months, only used for 6 months, then what it means is that we're gonna factor that into a annual basis. Okay, so 6 months over 12 months, so basically it's half year. That makes sense? So will be 12% times 0.5, that'll be 1,000 times 6% will be $60. Okay, that'll be $60. Or if the principal is $1,000 and the annual interest rate is 24% and we only use the money for 3 months. For 3 months. Now, how do we calculate the interest rate for using $1,000 for 3 months? That will be $1,000. The interest will be $1,000 times still the annual interest rate. And so for using the money for 1 year, we'll be paying 24% of interest. And now we only use the 3 months. Okay, 3 months over a year will be a quarter of a year, right? So that'll be $1,000 times 0.25, which will be $1,000 times 6%. Okay, that'll be $60. All right. So if we are using the money $1,000, okay, and 30% interest rate, and use the money for 2 years, okay, for 2 years. Okay, one way you can calculate interest is times 30%, and based off on our calculation, you can either just simply multiply by 2 or 1,000 times 30% of annual interest rate and times for using 2 years, and convert that into a monthly basis will be 24 months, and over 1 year is 12 months, so it's still gonna be 2, right? It's still gonna be 2. So that's gonna be 1,000 times 60%, which is 600. That makes sense? So this is how we calculate interest. All right? This is how we calculate interest. All right. So recording notes receivable. This example, on July 1st, 2018, company issued a $1,000 12 months 12% promissory note to Julia, and then on the date we issue this note, we're going to debit notes receivable. Okay, something we'll be receiving in the future. Okay, similar to accounts receivable. And $1,000, and credit cash for $1,000 because we really lend out $1,000 cash, and our cash balance is decreased by $1,000, right? And next is accrual interest earned. Okay, so what it means is that accrual interest earned at the end of the year, December 31st, 2018, which is the date when we prepare 2018 annual financial statements, right? We have fiscal year and financial statements need to prepare for each fiscal year, and this happened to be the fiscal year end for tech comp company, so we have to accrue the amount of interest we earned for borrowing out this or lending out this $1,000. Okay, so on July 1st, the company issued $1,000 and 12 months 12% notes. When it comes to the end of the fiscal year, $60 of interest has accrued on the note. So let's walk through the calculation first. The note principal $1,000, annual interest rate 12%, and up to now, December 31st, 2018, from July 1st, 2018, it's 6 months out of 1 year, so it's 6 over 12. So for using the money, for Julia using the money for 6 months, she has to pay $60 interest to tech company. And for tech company, for lending out the money, $1,000 up to this point of time, the end of the year, they have earned interest revenue of $60, okay, of $60. And then we will have debit interest receivable because we are not receiving the interest revenue at this point of time. And why is that? Because principals and interest will be paid together when this note comes to mature, okay, on the maturity date, which is July 30th, 2019, all right? But up to this point, remember, we have to make accrual adjustments to adjust and to reflect the true revenues and true expenses for the whole operation year, okay? Year of operation, all right? So we debit interest receivable because Julia used the money for 6 months, and then for the 6 months use, she has to pay $60 interest, okay? And we are not receiving that now, so we're receiving that in the future. That will become interest receivable, okay? So debit interest receivable and credit interest revenue. Why we credit for interest revenue? Because really it is another source of income that we earned through some other activities, okay? We call it revenue, but it's not the revenue earned from the regular operating activities, okay? It's called from financing activities, okay, or investing activities. Depends on the type of the notes, all right? So that will be interest revenue. We earn that money, we lend money for use, and then based off on that $1,000 principals that we lend over, and that's $60 we earned as interest from Julia, all right? So now here, recording collection on note at maturity. So remember, the notes last for 1 year, 12 months, right? So from July 1st, 2018 to June 30th, 2019, right? This whole 12 months. But this is the date we have to prepare financial statements for fiscal year of 2018, right? So at this point, the company hasn't received principal nor interest yet. They will receive the $1,000 and the 12 months use interest together on this date, okay, on this date. So remember, on this date, Julia will not only pay back that $1,000 principal, but also $1,000 in principal, but also $112 interest, right? $120 interest. So in total, we receive cash on that day. On that date, we receive cash of $1,120. And where do these $1,120 come from? It comes from the principal and interest, right? The principal and interest. So we debit cash for $1,120 and we credit for first notes receivable, which always gonna be the principal amount, $1,000, okay? $1,000. And why we have these two different entries here on the crediting side, on the credit side, interest receivable and interest revenue. Remember, out of this $120 interest, $60 interest is interest revenue earned during this 6 months of in 2018, and at the end of this date, on that date, we already recognize the interest revenue interest revenue, which is $60, and we have something interest receivable, right? We have something interest receivable, which we are going to receive in the future. And now, at the end of the maturity date, on the maturity date, we do receive that $60 that we should have received from Julia. So we no longer have interest receivables for this $60. So we will credit interest receivables for $60 to decrease the balance. And at the same time, for this 6 months in 2018, Julia used that $1,000 notes for 6 months in 2018, which means the interest for letting Julia use the 6 months in 2019 is the interest revenue we earn from lending the money to Julia for the 6 months in 2018, and that becomes interest revenue $60 for year of 2019. Okay, so the complete journal entries for recording collections at the maturity date is debit cash 1120, which is the principal plus total interest, okay, and then credit interest receivable $60. The interest we are expecting to receive, and interest revenues, that's the interest earned for letting the person using the principal in the current year, and then the notes receivable, that principal amount that we issued on the issue date. Okay. All right. Now let's work on an example. Okay, work on a practice problem. All right. Where is it? It is here. Okay. All right, and this example, this practice problem is on page, you see it is on page 378, okay? It's on page 378 in your textbook. Again, if you cannot see this very easily, you can open your book to that page, and it's exercise 8-12, all right? Recording note, receivable transaction, including accrual adjustments for interest, all right? To attract retailers to its shopping center, the marketplace mall will lend money to tenants under formal contracts, provided that they will use to renovate their store space. On November 1st, 2017, the company loaned $100,000 to a new tenant on a one-year note with a stated annual interest rate of 9%. Interest is to be received by Marketplace Mall on April 30th, 2018, and at a maturity date and at maturity on October 31st, 2018. Okay, so required. Prepare journal entries that Marketplace Mall would record related to this note on the following dates: November 1st, 2017, December 31st, 2017, and April 30th, 2018, and October 31st, 2018. So remember here, the second one, December 31st, 2017 is Marketplace Mall's fiscal year end. Okay, that tells us something. Okay, that tells us something. All right, which means we need to make adjusting journal entries somewhere. All right, so here is the information that we need. All right, here's the information that we need. Okay, so the company loaned $100,000, which is the principal, and the annual interest rate is 9%. So for using that money for 12 months, for a year, whoever used that money has to pay 9% interest, okay? And interest to be received on 2 dates. April 30th, 2018 and October 31st, 2018. But we are going to make journal entries on 4 different dates. Okay, so first one, A. Remember, when we record journal entries, if there are dates, we need to use the date as the journal entries indicator, okay, the reference number. All right, so first one is 11/1, 2017, okay, and for that we are always going to debit something and credit something. And November 1st, 2017 is the date when the company loaned $100,000. So that means on that date we have a notes receivable, right? Note receivable for $100,000. And then we create a notes receivable, and to have a notes receivable, that means we're lending out money. That means our cash balance will decrease. So in this case, we lend out $100,000 cash, and our cash balance decreased by $100,000. All right. So that is the first journal entry we'll make. And the second one is on the December 31st, 2017. Which is the fiscal year end for the issuer. And remember, on that date, we have to make annual adjustments, right? Annual adjustments, accrual adjustments, okay? Accrual adjustments or deferral adjustments, remember from chapter 4, okay? And in this case, what do we need to record, or what adjustment journal entries we need to make is about interest revenue and interest receivables, right? So now I'll do the calculation, all right? So interest, we need to calculate interest, which is principal times interest, annual interest rates times the time, or let's say time fraction, okay, or annual year fraction, okay, fraction of the year, okay. So in this case, the principal is $100,000 and the annual interest rate is 9%, and that, remember, that is 1 year interest. This is a 1 year interest, and at this date, December 31st, 2017, and from the issue date, which is November 1st, we have lent out money for 2 months, right? So for lending this money for 2 months, how much interest revenue we have to recognize for 2 months use of interest, the principals, excuse me, right? So that will be 2 months over 12 months, okay? And then it will be 100,000 times 9% times 1/6, right? So that is $1,500, okay? That's $1,500. All right, so now we can make this journal entry for that date, okay? So at the end of fiscal year, okay? The fiscal year end, excuse me. And then we're going to debit. Remember, this is not the date we are going to receive interest, okay? So we don't receive interest on this date. So we are going to have something called receivable, right? So that will be interest receivable, 1,500. What do we credit? We'll credit interest revenue for 1,500 because this is the interest we earn by having the person use our money for 2 months. All right, so this is the journal entry we make at the fiscal year end for this problem. And the third C is on the date of April 30th, 2018, right? 2018. Okay, so for 2018, what have we received? We only receive interest because principals only will be repaid when it is mature. Okay, when it is mature. So now from 11/1, 2017 into for April 30th, 2018, we have how many months? November, December, January, February, March, and April, right? So 1, 2, 3, 4, 5, 6. Okay. On that date, we have let whatever the person is using our money for 6 months. Okay, for 6 months. So the interest calculation here will be $100,000 times 9% times 6 months over 12, which is 100,000 times 4.5%, and gave us that $4,500. And that means on April 30th, 2018, we are going to receive in total $4,500 cash. Okay, this is the date when the interest, at least part of interest has to be paid. Okay, so we'll debit. So that's a real cash income. So that's cash, debit cash for $4,500. And out of this $4,500 interest, $1,500 interest has been recorded as revenue for last year, 2017, right? 2017, and we have a interest receivable from prior year, 2017, right? So since we are receiving that $15,000 now on April 30th, 2018, we are going to reduce interest receivable by $1,500. Okay, and then we're going to credit interest revenue for another $3,000. Okay, and then the balance and the balance is equal, right? Equals debit and credit. And where does this interest revenue of $3,000 come from, right? So let's go back to here. Okay, go up a little bit. Okay, so at the end of December of 2017, we recognize 2 months use of 2 months interest revenue, right? So now for 2018, January, February, March, and April. This is 4 months use of our principal. So we need to recognize interest revenue for this 4 months. So 4 months interest revenue, that'll be 100,000 times 9% times 4 months use over 12 months. Okay. Connection is lagging. All right. So we have that 100,000 times 1/3, which is 3%. That it gave us $3,000, which is our interest revenue. All right, interest revenue. Okay, so this will be the journal entry we make, or this was the journal entry that we made on April 30th, 2018. Okay, so now it comes to the maturity date, which is October 31st, 2018, right? So this date, we are going to receive not only the principals, but the other part of the interest. Okay, the other part of the interest. Okay, so now let's make the journal entries for receiving the principal, right? So they are paying us back the principal. We are going to receive cash. The principal is 100,000. Okay, and then we are no longer have this notes receivable. So we are going to reduce our note receivable balance by the principal amount. Okay, and now we are talking about interest. Okay, interest. And the interest here is, okay, because from the above here, oops, come on, from the above here, that on April 30th, okay, April 30th, we already record interest revenue for 4 months, that January, February, March, and April. Okay, we no longer need to re-recognize the interest revenue for this 4 months. Okay, because we already recognized that once. April 30th, we no longer need to record it one more time when it comes to the maturity date. Okay, so from April 30th, 2018 to October 30th, 31st, 2018, how many months here? We have May, right? June, July, August, September, and October, right? So 1, 2, 3, 4, 5, 6. Okay, 6 months, right? 6 months. So now let's calculate this 6 months of the interest revenue for this 6 months. Okay, so $100,000 times interest rate of 9% and times 6 months over 12. Okay, remember this interest rate is annual interest rate. Okay, this is annual interest rate, and by having this factor, okay, the month fraction here, we are going to get a monthly interest rate or 6 months interest rate by having this section. Okay, by having this section. Why it's not? All right, and then you will have, okay, it seems like it works. Yes. Okay, so by having this section, so then 100,000 times 9% annual interest rate and times 6 over 12. Okay, so this part gives us the 6 months interest rate. Okay, so for using 6 months of the principal, how much interest rate, what is the interest rate? Okay, so that'll be times 4.5%, which is $4,500. Okay, so now we are able to recognize the interest revenue for letting the person using our principal over the period from May, June, July, August, September, all the way to October. Okay, so now the interest, we receive cash of $4,500, which is our interest. Okay, the other part of interest and credit, interest revenue and that is the interest revenue we earned for letting the person using the money over the period from May to October. Okay, so for on that date, October 31st, 2018, when it's come to mature the notes, and we make two journal entries. Okay, first journal entry is notes for receiving the note payment. Okay, note payment, which is the principal. Okay, is that right? Principal. Okay, and that's debit cash for $100,000 and credit notes receivable for $100,000. And the second is to receive the other half of the interest. Okay, receiving the second half of interest, and to recognize the interest revenue for the period from May to October, which is debit cash for $4,500 and credit interest revenue for $4,500. Okay, and also if you are very familiar or you are very good at making journal entries, you can see here really these two journal entries, you can make it into one single journal entry. So that will be with debit cash in the first one, and here in the second one also debit cash, right? So instead of having two journal entries, we can make one single journal entries for these two different process, and we debit. Come on. Alright, so we'll debit cash for the sum of $100,000 plus and $4,500 debit cash, which is $104,500. Okay, $104,500. Okay. And then we'll credit accounts, we'll credit notes receivable for $100,000, and another part is interest revenue for $4,500. So instead of making these two journal entries, you can make one single journal entries as this. Okay, that's also okay. All right, so this is for notes receivable and interest based off on the notes issued. Okay. All right, now let's come back to the lecture PowerPoints, which is the very last topic, the interest, receivable turnover ratio. Okay, so remember in the inventory chapter we talk about inventory turnover ratio, right? So we want our inventory turn around quickly. Okay, we want to get those inventories in and then sell them as faster as we can, right? So for accounts receivable, it's the similar concept. Okay, we extend credits, we offer credits to our customers, and we expect them to pay us in the future days. And the sooner they can pay us back, the better we can use the money to do something else. Okay, purchase materials, purchase other supplies, and then sell it to customers to make more revenues, right? So we want our accounts receivable turnover as quick as possible. Okay, so receivable turnover analysis, this is the equation. Again, I will not ask you to memorize this equation, but still you need to understand what this number tells us, right? So accounts receivable turnover ratio is net sales revenue, okay, net sales revenue, and it's not cash sales or credit sales. It's the total net sales, okay, net sales revenue, which includes both net cash sales and net credit sales, okay, and divided by average net receivables. Net receivables is the net realizable value of our accounts receivable, which is the original accounts receivable balance minus the allowance for doubtful accounts balance, and the difference is our net receivable balance. Okay, and the average net receivables is the beginning net receivables plus the ending net receivables divided by 2. Okay, usually we are looking at this turnover ratio for annual information, okay, on annual financial statements, So then that means the beginning net receivables will be the beginning balance of our net receivable, and ending net receivables will be the ending balance of the net receivable balance of the year financial statements, especially particular the balance sheet. Okay, so now here this year the annual net sales revenue is $500,000, and the average net receivables, which is beginning plus the ending net receivables balance divided by 2, which is $50,000, and it's 10 times. So that means over the year that revenue over the receivables turn over 10 times. Okay, turn over 10 times, and days to collect, there'll be 365 days, okay, divided by the receivable turnover ratio, very much similar to days to collect, days to sale, okay, the inventory, okay, and it's very much similar to inventory turnover ratio, okay, that's 36.5 days, which means, okay, from the first day you made accounts receivable, you create an accounts receivable or you sell on credit, and it will take on average 36.5, probably about a month to receive that receivable. Okay, to receive that receivable, and accounts receivable is a really important financial ratios. Okay, it's one of the important financial ratios that everybody will look at, especially if this consulting company that's doing consulting work for a particular company, and this is one of the ratios they will look at. Why? Because this will by comparing the year-to-year accounts receivable turnover ratio, turnover ratio, you can see the trend that customers is paying back quickly of the receivables, or paying later, slower. Then this information sort of indicate us about our future cash flows, right? Because remember, cash flows is very critical part of doing business. If we run out of cash, even if our other financial factors or sections looks perfect in the world, but if simply because we are run out of cash, we are not able to continue our operations, then we have to go bankrupt. Remember, so this receivable turnover ratio really can help us to have some kind of predictions about our future cash flows, and then we can make some strategies accordingly. All right, and again, if we're looking at financial statements and looking at calculating these ratios, and we are trying to comparing some companies' financial positions, performance. Remember, we cannot compare companies from different to completely different industries. Another way of saying this, we cannot compare oranges to apples. Okay, so they have to be in the similar situation. They have to be in general in the same industry, and they have to do the similar business, so that you can have a better sense whether they are operating their credits or policies effectively or efficiently. All right, so comparison to benchmark, this is what we're talking about when we do financial analysis using those ratios. Okay, and speeding up collections. Okay, so sometimes if companies run into bad debt or uncollectibles, they will factor it to some third-party collecting agencies. Okay, so they will sell their accounts receivables at discount to a third-party company. For example, if you have $1,000 accounts receivable that you think you are not able to collect in the future, you can sell it for $800, which basically is 20% discount off to a third-party debt collection companies or agents. Okay, so then they will give you that $800 cash and to have the authority to collect $1,000 accounts receivables from your clients. So another way of saying this is that as soon as you sell this accounts receivable to the third-party debt collectors, that is no longer your problem to collect those money, or you lose those accounts receivables. Okay, you already received the $800 from the debt collectors, so they will be the debt collectors' problem whether they can collect that $1,000 from your clients or not. Okay, so that will ease attention, or at least try to save the cost or reduce the loss. Okay, and credit card sales are most of the companies now is doing credit card sales through bank credit card, or PayPal, or there's another payment method. It's the word starting with the letter V. I can't remember what that thing is, but it's similar idea that they swap their credit card and they pay through PayPal. Okay, so the third party company will take the money from your customers and then charge for a fee, and then deposit in your bank account several days later. Okay, so that's more secure than just simply extending or offering credits. All right, so that's pretty much about chapter 8. Okay, so after this video, please make sure you understand everything. Otherwise, post your questions on on the discussion board on Blackboard, and I will check on that before the homework due. And then don't forget to do your homework. And also after this chapter, you are going to have a quiz that on chapter 7 and chapter 8. Make sure you finish both the quiz and the homeworks on time. All right, on time. Remember, late work is not acceptable. All right, so if you have any questions, don't hold it until some other later dates. All right, so have fun and good luck with your other classes, and enjoy The Sunday probably it's gonna be a sunny Sunday. At least here that will be. All right. I'll see you in the next lecture videos. Bye.